Hi everybody, Bob Carey here with First Trust. Thanks as always for checking in with us here. There's certainly been a lot of noise about government shutdowns and the economy and all kinds of issues relating to the Fed, and yet investors have just kind of hung in here in the last couple of weeks since our last update. The fact is the market last Tuesday hit an all-time high for both the Dow and the S&P. The S&P 500, the S&P mid-cap, small cap indexes have hit new highs multiple times this year, but we finally got the Dow to play along, which has lagged behind a little bit this year. At one point last week, the S&P 500 had returned 25% year to date, one of the better years that we've had in quite a while. You've got to go back to about 1997 to have the kind of year that we have had so far this year in the stock market. Unfortunately, for investors in what I call the safe asset classes, cash, bonds, defensive stocks, really they've had a hard time since the springtime, if you will, this year. And I think investors are beginning to realize that the economy overseas is beginning to pick up, whether you're looking at China, Japan, even the economic data coming out of Europe has improved a fair amount here in the last couple of months. So in spite of all the headlines and all the talk about the world coming to an end because of this or that, the fact is the market has done what it usually does, and that's defy expectations. And now, as we look to the end of the year, we have another week or two, if you will, of earnings reporting season, but for the most part, we have a pretty good sense of where earnings are to come in for the fourth quarter, and we also have some pretty solid numbers to think about for 2014. The fact is the market is selling at about 14 times 2014 estimates when you're looking at the S&P 500. If in fact earnings do come in the way the analysts are computing them to be, we are looking at a pretty decent year in the market next year. Now we have seen money in effect start to flow out of the market in the last couple of weeks. It seems like investors in the last 3 or 4 trading sessions in particular have decided to take some of their gains for the year, and it's really not all that surprising. So in the near term, looking at over the next couple of weeks, the market looks like it may be vulnerable to a bit of a correction of maybe 3 to 4, 5% at the most. However, we are setting ourselves up for a terrific year next year. If in fact we start to trade closer to normal, whatever that may be, but basically in line with historic long-term averages on a price-to-earnings multiple, the market has upside in the range of 25 to 30% over the next 12 to 18 months. If in fact the Fed remains accommodative, and it looks like that's going to be the case if earnings come in as expected, and if we continue to see the situation overseas improve and maybe Washington gets somewhat out of the way, there's certainly a lot more upside to the market than there is downside. Obviously, any of these issues could wreak havoc in the short term, but the fact is the market at this point looks to be poised for further gains here. It's a lot like 1996, 1997. We had a great year in the market in 1995 after several tough years, and the fact is that it takes a while for investor confidence to build, and it is in fact beginning to build, but it's certainly not 1999 or 2000 with the market selling at 30 plus times earnings. We may get there, but the fact is that we're going through a cycle that looks very normal ultimately, than a lot more normal, I think, than many people are willing to admit or even recognize. So with that, we'll check back in with you, of course, next week. In the meantime, have a good one.